Well, good afternoon, everyone. Welcome to another exclusive App 12 Partners event, Work and AI. I'm Andrew Dunbar, one of the directors of App 12. Now, quick disclaimer before we start today. What's covered is not personal advice. It's general in nature and it should not be taken as a recommendation. So just starting with some housekeeping. If you've got any questions throughout the presentation anytime today, just use the Q&A box in your Zoom menu there, and we'll get to as many of those questions at the end. Any that we can't answer, we will get them answered and send those out with the recording. Well, there's plenty happening in the world in 2025, isn't there? And when making financial decisions, it can be easy to get caught up in the noise. But the apt investment team are working hard in the background here to stay abreast of those developments to help you make the right moves. So today we're going to hear from a couple of speakers. Firstly, Sarah Gonzales, Chief Investment Officer at Apt Wealth, and then Julie Scurfield, Regional Sales Manager at Vanguard. And Sarah will briefly touch on the state of the markets, and Julie will give some insight on artificial intelligence and its transformative impact on business, the way we work, and the ramifications for investors. So without further ado, let me introduce Sarah Gonzales. She's well known to many Apt Wealth clients. As Chief Investment Officer, she provides portfolio construction solutions for advisors and their clients and manages the Apt Wealth Partners portfolios together with her team. Over to you, Sarah.
Thank you, Andrew, and welcome to everyone that's dialed in today. As Andrew mentioned, I will be running through just a quick overview of what's happened over the last 12 months and what we're seeing as the outlook for the next 12 months. And so looking back at the last 12 months, as you can see in the graph on the slide, all major asset classes generated positive returns over the 2025 financial year, with cash, as you can see there at the bottom of the returns scale, albeit, returns still cash still returning 4.4%. So it was a very good year for asset classes for investment portfolios. And it's really been about 6 years since all asset classes generated a higher return than cash. The last time we saw this was in 2019, just before the COVID pandemic. And so what we really saw over the last 12 months, particularly in the first half of FY25, was, the market really being driven by technology, in particular AI, central banks cutting interest rates, with the Federal Reserve cutting rates for the first time in the US in over 4.5 years. But then we move on to the second half of the year, where earlier at the start of this calendar year, we saw the S&P 500 and the ASX 200 reach all-time highs, and 10-year bond yields reaching, 4%. So really declining there at the start of the period. However, moving into the year, what we saw, President Trump was inaugurated as the next US president, and he announced his plans to increase tariffs almost across all global trading partners on what has been termed as Liberation Day back in April. And so we saw global equity markets sell off, bond yields start to rise again, and the value of the US dollar decline since then. And one of the metrics that we saw really spike during this period, as you can see in the graph there, back in April, was the volatility index, or known as the fear gauge, really spiked when Trump came in and the tariffs came in, because there was a lot of uncertainty in regards to the impact these tariffs would have. And while US tech dominated the first half of the year, the second half of the year, we really saw global equity market returns start to broaden. And you saw 80% of global equity markets generating positive returns, and 50% of markets up more than 10%. So you're really seeing the broadening out of returns occurring over that period. And so what are we seeing for the next 12 months? What we've seen, the effective tariff rate has come down, and we're seeing global GDP growth really start to be impacted. Um, the recent forecast by the World Bank is showing that global GDP growth is going to come down and will be the slowest it has been, since the 1960s for the decade of the 2020s. What we're also seeing is tariff prices starting to be reflected in US prices. So the effective tariff rate in the US has declined from 22% that we saw on Liberation Day to an estimated 15.8% currently. So this is a significant increase to what we saw back in December, where the effective tariff rate was sitting at 2.3% back at the end of 2024. So the US reported inflation rate of 2.7% for June is up slightly from 2.4% reported in May, which really reinforces, a lot of the concerns in the market that President Trump's tariffs will resort to high inflation over in the US. And the graph shown here is a graph that is tracked by the Harvard University Pricing Lab, and they track the price. They have tracked that the price of imported goods and into the US and domestic products affected by tariffs have been rising more rapidly in 2025 than domestic products that are not affected by tariffs. So we're really seeing there that goods and services that are affected by tariffs, prices are starting to increase. What we're also seeing is inflation starting to moderate globally, with the exception of the US. So the Organization for Economic Cooperation and Development, or known as the OECD, expects annual headline inflation for G20 countries to moderate to about 3.6% in 2025, from 6.2% growth that we saw last year, and moderating further in 2026 to 3.2%. So really seeing inflation moderating for other regions, with the exception of the US, where inflation is expected to be just under 4% later in 2025 and remaining above the Fed's target for 2026. As I mentioned, in contrast, other countries are expected to go through a period of disinflation, which is a reduction in the rate of inflation. So the European Central Bank is expected to continue easing monetary policy. Fiscal policy is expected to be supportive for economic growth in the euro area, with half of the EU Recovery Fund still planned to be spent over the next 2 years, with a strong focus on infrastructure. There's also been a change over in the euro area around fiscal rules that allow defence spending outside of the 3% deficit limit to increase. And so this allows increased spending and investment in other areas. Over in the US, the Fed appears to be in no hurry to make significant changes to monetary policy. The current environment is making making the job for the Fed a lot more difficult, particularly with higher tariffs and government spending cuts likely to impact the US economy. President Trump's Big Beautiful Bill is expected to add more than US $2 trillion to the US deficit over the next decade. Over in Australia, the monthly CPI rose to 2.8% for the 12 months of July, which was up from the reading in June at 1.9%, and marks the highest annual inflation rate since July 2024 in Australia, which had been coming down and easing for a few months there. So the July inflation read has got the market a little bit concerned around what the RBA will do for the rest of the year, with the expectation that the RBA might not cut interest rates further for the rest of the year. And so what does that mean for investment portfolios? You would have seen this if you've dialed into previous webinars, and Julie will actually touch on a lot of these points in her slides. But, sticking to the plan, that you've created with your advisors, maintaining a buffer of safety, taking advantage of weaknesses, focusing on quality investments, diversification, and regularly rebalancing your portfolios. But I think what I would highlight is, in a world of transition, this creates opportunities to invest in long-term investments, high-quality assets at attractive valuations. So focusing on long-term company fundamentals and trends occurring in investment markets. So long-term themes like AI, automation, defense, and infrastructure spending, aging populations, and the energy transition continue to be long-term investment themes. So companies are starting to see, as you can see in the chart here, positive revenue increases with business units using generative AI. And, this is going to continue to be a long-term trend, and looking at, investments, not just in the short term and over the long term, will continue to be the focus. And this will continue to be discussed in Julie's slides. So I won't talk much more on that. And with that, brings me to over to Julie, who will discuss portfolio construction and the AI theme that we're seeing in more detail. So Julie Scurfield is the intermediary sales manager, regional sales manager at Vanguard. In this role, Julie leads the team of sales executives who focus on distributing Vanguard products and services to advisors and financial planning groups like us. Julie has been in the industry for over 20 years. Prior to her current role, Julie was in research. And with that, I'll hand over to Julie.
Much, Sarah. Very, very much appreciated. And I hope we are all well on this very, very sunny Monday. Can people see me?
Perfect. Thank you, Julie.
Okay, great. Is the video sharing?
Perfect. Thank you.
Okay, great. I will be 2 minutes. Today is going to be all about AI innovation and transformation. And I guess before we get started, I really wanted to take away all the buzz noise of what's been talked about when it comes to AI, exploring whether AI is going to be simply the next wave of technology, or if we should be thinking about this something deeper, and if we should be doing something differently with our investments. There's definitely going to be a lot of industry trends and implications. So understanding what that means to your investments, to your work, to your life, and then how it's going to affect what you do short and long term. From a Vanguard perspective, we are very excited, but we do want to put it in the snapshot of what AI will mean to us day in, day out. AI innovation and transformation. I think the big question definitely want to wrestle with today is, should we be more bullish on the global economy as AI takes shape? Or should we be looking at this more cautiously? The truth is hard to know where to look, and harder still to know what signals really matter. So in this session, what we want to share is that the world is shifting in many ways, but most of us just don't see it yet. I'll bring to you the insights from our global investment strategy team at Vanguard. It's been nearly 7 years in the making, looking at AI and what it means in the global context. But what we had to do to do this research is actually zoom out over the long arc of history to identify what the signals were. They've always pointed to transformations that are bigger than what anyone ever expected. And right now, those signals are flashing again. The point is this: there is an investment strategy that doesn't just weather these shifts, it actually embraces them. And we believe that AI, if you're willing to tune in closely to see the risks and the disruptiveness for what it is, You can recognize what the headwinds are, and what the forces will be that create opportunity. So our job today is to convince you not just to think differently about the future, but to really feel the weight of what's coming, the risks, the opportunities, and the choices we'll have to make in the next 5 years at least. But before we look forward, let's look back, because sometimes to see clearly where we're heading, we probably need to look what's behind us. And I'm going to take you to this image. Sarah, if you could go to the next slide for me.
Yep.
Okay, so as I mentioned earlier, history does give us a way to look forward. And there was about 100 years ago, people stood for this pic. It was in the middle of nowhere. And without even realizing it, they were probably looking at history in their eyes. It was one of the first photos shown to me when I was in primary school doing one of my first assignments. And the first thing that stood out was the aeroplane coming down, and the shock and imagination these people would have felt in a rural town in Alaska. It was about 1920 this photo was taken. Barely 100 people in this town, and yet within a single decade, America went on to undergo one of the biggest transformations in history. The United States was shifting from farms to factories, from a rural economy to an industrial one. Immigration had surged. Up until then, millions arriving from Europe chasing opportunities. Mass production had exploded, but by the end of that decade, America was exporting half of the world's manufactured goods. Half. That's a lot to get your head around. Manufacturing. Not the case now. Think about what that meant for the people in this photo. They had no idea what was coming. They didn't know their way of life, their work, their communities, even the rhythm of their daily living was about to be rewritten. But history shows us transformation is rarely obvious in the moment. It only feels obvious when you look back. And that's a lesson for us. We're in the middle of change right now. We can't afford to stare only at the aeroplane, in this case AI, at the shiny distraction in the sky. We have to notice the people, the world shifting around us, and the forces reshaping our future. The real question isn't, is change coming? Is if we're paying attention. So we might move to the next slide, because I think this one's going to be a great one, a great example of where growth happened due to technology. So I'll get you all to try and remember those history lessons back at school and think back to 1920. Here's when things really changed, I think, for the world. And this chart really illustrates that. It's US productivity over the last century, and for decades, growth bumped along steadily. Then suddenly it spiked. That leap wasn't random. It wasn't powered by technology. But what's fascinating is that almost no one saw it coming. Think back to that photograph that we just looked at. Miners in Alaska, families gathered in a dusty town of 100. They were thinking about productivity curves or industrial revolutions. They were just not trying to get through the day. Yet beneath the surface, forces were building. That assembly line, electricity, then tractors, they weren't just new tools. They rewired the way humans lived and worked. They reshaped entire economies. And here's the kicker. Change looks obvious in hindsight. Electricity coming in and changing for them, but invisible in that moment. What begs the question, when you look back on our own time, will we say the same thing? The transformation was happening right in front of us and most of us missed it. When that photo was taken, immigration was to decline from 1 million a year to only 200,000. Tariffs went on to be 40% for the next decade. So there are a lot of similarities in relation to the uncertainty those poor people were feeling and what ended up eventually happening. But now let's move over to the next slide. And that's the good, the okay, and the ugly. What we need to consider. What do we mean by the good, the okay, and the ugly? Economists talk about general purpose technologies. Think of the breakthrough that ripple through every corner of our society. A great example is electricity. Think about it. Once power grids spread, factories could run day and night, homes lit up after dark, heaven forbid, cities transformed. It lifted everything. The okay example is computer and the internet. Hugely impactful, yes, but slower to translate into broader base productivity. The benefits were real, but they unfolded unevenly across decades. And then there's the ugly, the moments where no breakthrough appears, innovation stalls, productivity flatlines, the world feels stuck, waiting for the next big leap. So here we are standing at another possible inflection point with AI and GPTs. The question is, which story will it be? Now, I must say, given the research we've done, there's conflicting evidence whether it is going to be that transformational, but let's talk about that in more detail. Will it be the electricity, the world, like the light bulb? Will it grind forward slowly like the internet? Or will it fizzle, leaving us waiting for the next real game changer? History says we won't know right away, but as investors, we can't afford to sit still because the upside of getting it right is massive. We'll just move to the next slide, Sarah. When we're talking about this and as we're going through some of these key themes, I want you to think of innovation versus transformation. And innovation, talking automation, assembly lines, tractors. When you're talking transformative, think computer and electricity. And I'll tell you what the dividing line is between there. On one side, you've got innovative technologies. These are powerful, yes, but they're incremental. They automate tasks. They make us faster. They make us more efficient. Think of tractors replacing a team of farm hands. Think of assembly lines speeding up production. Big gains, but still within the same sort of a framework. Then there are the transformative technologies. These don't just speed up the old way. They create entirely new ways of living and working. Electricity just didn't make lamps brighter. It created whole new industries. Computers didn't just replace the typewriter. It rewired the global economy. That's a critical distinction. Innovative tools improve productivity at the edges. When it's transformative, it reshapes a game altogether. So the big question today is AI going to be another clever tool in the kit or the next electricity that's going to map human progress? The next slide, Sarah. And I think this was really interesting research. Our global investment strategy team and economists went on and really wanted to nut this question out and have an understanding of, okay, really when things are going to make a really transformative change, it's got to be able to make an impact on a wide variety of areas. So what our research team did is look at 800 different occupations. The most marginal impact of AI will be roles like electricians and some of the physical trades, a lot of the physical movement. That's going to be tough for AI to do unless it merges with robotics. So it will be modest time saving and productivity gains. So low exposure, things that are going to impact AI. A good anecdote is like spell check in Microsoft Word. It helps, but it doesn't replace your writing skills. AI-powered email sorting, basic chatbot responses, calendar scheduling. It's good. It's a time saver. And then you think of What about medium time saving, 20 to 40% time saving? Think of Google Maps. You can still drive and actually work out how to get from A to B. AI helps you get there faster. AI assisted legal research, accounting using AI for financial modeling, data analytics, automating reports. And then you've got the high exposure, the things 40% plus where it's going to add a higher level of productivity. Imagine an Excel spreadsheet that you don't have to work on, that builds itself. AI can now generate entire reports that used to take humans days. AI medical diagnostic, automated warehouse logistics, customer service AI replacing basic call center functions. Steady, repetitive, lower impact jobs that organizations historically took for granted. AI is targeted exactly for those routines. Rules-based, information process tasks that used to require armies of people. So what are going to be the roles? They're going to be things like data entry clerks, accounts payable, basic HR onboarding tasks, customer service, content and communications. But then you've got your higher jobs. Think of any jobs that requires human contact, where you need a human to decisively think and understand situations. AI is never going to replace what humans need to be able to do. The information was already there via the internet, but we needed a human to be able to help us decipher that. So we've pulled it apart and we've had a look at some different sectors, law, accounting, even an entrepreneur, and taken their day-to-day roles and had a look at what can be automated and what could be augmented. And I think this really feeds into the reason why we did this research is we had so many people asking, what should I investing in next? With all this AI taking place, what should I be considering? Let's have a look at something like, Sarah, if you can turn to law and the top tasks and AI exposures. So when you take the life of a lawyer, what do they have to concentrate on? Contracts, review and due diligence, the legal research, case and law analysis. And then you've got the litigation risk and assessment, negotiation and client advisory. Some can be automated, so some can be augmented. So that means that on average, something like law, they're going to get about a 40% productivity gain. The next one is accounting. Again, contract reviews and diligence, tax compliance and checks can all be automated. What needs to be augmented is fraud, client advisory, strategic planning, risk assessment. That will all need some level of human interaction, but again, a massive productivity gain. So when you're thinking of where to invest for tomorrow to get the gains of AI, we are looking at it. What are the industries that are going to be able to get the productivity gains from AI, and how will they be able to do that? It's not only the productivity gains, how is the regulatory reform going to shape to allow those industries to embrace AI? How will they be able to secure your data? How will they be able to work and keep their technologies and their advancements continuing to grow? What about the new industries that are going to be able to start up? So when we look at entrepreneurs starting an online business, for example, there's so much to do. Market research and competitor analysis. You've got customer support that you could use chatbots for an automation. Product sourcing and inventory. And then you've got the website and social media, business strategy and leadership and team building. At least 50% productivity gains from areas like entrepreneurship. It will make it a lot more attractive for people to try new things. So again, when it comes to where you should be investing tomorrow, think of all the gains that people are going to have, the extra time people are going to be able to use at their disposal to ensure that they're more productive. So we'll move to the next slide now, Sarah. Thank you. Professions for AI automation highest of risk. Again, we mentioned things like admin, clerical data, bookkeeping, retail sales, automated checkouts, inventory, legal assistance, paralegal. AI can streamline all of that. What are some of the low risks? Healthcare, doctors, nurses, caregivers require human judgment. Education, teachers, trainers, definitely they'll benefit from the advancement of AI. And it will allow for mentorships and greater adaptability to different skill sets. The creation of different industries, artists, designers, musicians will rely on originality and always will. Traded and skills labour and management and strategy. So yes, some professions on the next slide are at a higher risk of automation, admin and clerical roles especially. But if you zoom out, the real story isn't about jobs being replaced, it's about the jobs being augmented. For every role that automation fully disrupts, there's roughly 4 roles where AI doesn't replace the human, but instead makes them more productive, makes them more effective, makes us more valuable. That's the 4-to-1 ratio you see right here. Think about doctors using AI to scan images in seconds, lawyers using AI to draft those contracts faster, or your financial advisor leveraging AI to analyze data faster for you. These are not cases of replacement. These are cases of acceleration. So the message is really clear for Vanguard and what we tell our investors and financial advisors. AI is much more than amplifying human capability than eliminating us outright. And for investors, that means a bigger economic upside in the long run, not destruction, but for productivity gains. I can't see any questions come through, so please let me know. We'll move on to the next slide. And this is a question we are always getting asked, and that's where will the upside actually show up? The US has innovation and capital markets, the epicenter of global tech. China has scale, huge data sets, rapid adoption and state backing. We saw that in the making of DeepSeek. The UK has research and financial strength, especially in fintechs and health tech. And Australia, we may not produce the next global tech giant, but we benefit as adopters, given our mining, agriculture, healthcare, and education all stand to gain enormously from AI. The lesson for investors is really clear here. The benefits won't be combined to one geography. They're going to ripple globally. And the best way to capture them isn't to pick a single winner, but to stay diversified across all the markets, to Sarah's point. So the next slide is on the industry trends, and that's global. And there's 3 major points here. So we'll start with the global picture, and that's 72% of businesses, what's happening right now, have already adopted AI in some form. That's up sharply from just last year when we ran these numbers. The pace of adoptions is accelerating. By 2030, AI is projected to contribute around 15.7 trillion to the global economy. Now, when you think about that, that's the equivalent of adding an economy the size of China. And the impact of productivity is expected to be material, about 1.5% points higher per year, which could lift global GDP by 7% or US 7 trillion over the decade. So again, AI isn't just a buzzword, it's already embedded in business models and is on track to materially shape global growth. And what it means for us at home, the next slide. Industry trends in Australia. 68% of Australian businesses have already integrated AI in some shape or form, with another 23% planning to do so in the next 12 months. We're catching up quickly. The potential productivity gains are estimated between 0.01 and 1.1 percentage points per year through to 2030. It doesn't sound huge, but applied across a whole economy, it's pretty meaningful. In dollar terms, AI could add up to 115 billion to the Australian economy by 2030. That will be about a 5% lift in GDP. So while Australia may not be leading in global AI platforms, the gains from adoptions, especially in sectors like mining, agriculture, healthcare and services, are what's substantial. We all stand to benefit enormously if integrate AI effectively. So when you go to that next slide, that pic that some of us may have seen in our primary school history lessons, when we look at that aviation picture, what I probably didn't mention was that here in Australia, we actually beat those Wright brothers who flew that plane. We pipped them to the post, because initially in 1903, it made a lot of history, the Wright brothers, because it was well documented, commercialized and scaled. But in 1902, months earlier than those Wright brothers, an Australian by the name of Lawrence Hargrave was already experimenting with box kites and powered flights right here at Stanwell Park. It didn't make the same headlines, but the innovation was real and in many ways just as pioneering. The lesson is this: breakthroughs don't belong to one person, one country, or one moment. And I strongly encourage you to think like that from an investment perspective. They happen in parallel, often in obscurity, and only some are remembered. And that's exactly the same point with AI. Some advances are going to dominate the news cycles and all that noise that we're hearing day in, day out. And others will quietly change the way we live and work without much fanfare. But investing, just like aviation, the story isn't about just who got there first. It's about who endures, who adapts, who builds something that lasts. And that's why we come back to the timeless investment lessons, something that Vanguard continues to encourage investors and financial advisors to think seriously about. The investors who thrive aren't the ones chasing the next big thing. They're the ones that stay disciplined, diversified and patient while the breakthroughs unfold around them. So I might, Sarah, go to that next slide, that timeless investment lessons.
Yep.
And I think my probably favorite lesson of all is compounding and the power of compounding over time. And it is probably one of my favorite charts, if we can move over to that. It shows the power of compounding over time. And Vanguard's founder, a gentleman by the name of Jack Bogle, said it best: time is your friend, impulse is your enemy. And this chart proves it. Each line in this chart represents what happened to only $10,000 if it was invested back in 1994 in the different asset classes. And Sarah's been great to be able to point that out. Global shares, Australian shares, bonds, property, and cash. If you fast forward to today, and that 10,000 in global shares has grown to more than 230,000. In contrast, the same 10,000 left in cash would have barely reached 22,000. That's the gap compounding creates over decades. Time in the markets beats timing the market. Even though volatility, the GFC, how many things took place? Who can remember them? COVID, rate hikes, The compounding engine of growth assets has kept working. Asset allocation matters. Shares drive long-term wealth, while defensive assets like bonds and cash help smooth out the ride. The right blend is what protects and grows wealth over the long haul. Think of it like planting an apple tree. If you planted $10,000 as a seed 30 years ago, you didn't need to stand over it every day stressing about whether it grew an inch or lost a leaf. You just let time and nature do its work. Fast forward to today, that single tree has become an orchard, producing fruit year after year. That's the top line on the chart, the compounding power of shares. Now, compare that to putting your 10,000 under the mattress or planting just a tomato plant. That's your cash line. It barely grew, and it certainly doesn't feed the family, that's for sure. The lessons: trees, like investment, need time to compound into something meaningful. The earlier you plant them, the greater the harvest. So when you look at this chart, don't just see those lines on the page, see the harvest that comes from staying the course. I'm sure you have heard this many a time as we continue to crunch these numbers and we watch letting compounding do that heavy lifting and keeping the right mix of growth and defensive assets. That's how it helps you as investors to ensure that you have that enduring wealth. So if we can move on to lesson 2, staying the course. I think this is probably one of the harder ones, I would suggest. And there is always a cycle and learning from the past. Now, if compounding is the engine of wealth creation, staying the course is how you actually benefit from it. This chart maps every bull and bear market. The green bars are bull markets. The gains are more than 20%. The real dips are bear markets, losses of more than 20%. What do you notice? Bull markets last far longer and deliver far greater returns than downturns. On average, bull markets run nearly 7 years with gains over 200%. That's on average. Bear markets, they're short, they're sharp, often less than 2 years with losses of around 30 to 40%. So while the headlines are the stuff that's memorable, the market noise are the ones that causes us to maybe make the wrong investment decisions. Downturns feel scary, even for people who've been in the industry for a long time. The long-term story is that the ups dramatically outweigh the downs. It continues to repeat itself. And here's a metaphor I like to use. Bear markets are like turbulence on a flight. No one enjoys it, especially not me. But the pilot doesn't land the plane mid-ocean. You ride it out because the destination, long-term growth, is worth it. That's why we always say it's time in the market, not timing the market, that builds enduring wealth. Another way, when you put it together, the lesson is simple. Compounding is your wealth engine. Staying the course is how you capture it. Other people talk about volatility, those bear markets, almost like a ticket to the game that earns you the right for that bull market. The investors who resist the impulse to react emotionally, who plant the tree and stay on that plane or buy that ticket, are the ones who harvest the rewards. Apologies for all the metaphors, but when you're going through this market news and these cycles, I think we need to refer to metaphors. Slide 23. This chart looks at global stock prices since 1980, and it really puts it into perspective because it highlights again every bear market, the downturn in orange, and every bull market again in green. Now, this is taking even a longer time frame. On average, bear markets lasted 9 months here with losses of around 30%. Bull markets, by contrast, lasted close to 3 years and delivered gains for nearly 100%. This is since 1980. We've seen 12 bear markets, but each one has eventually given way to a much stronger bull market. That's why historically the trajectory of markets have been up and to the right. Here's the way I like to think about it. Bear markets, you can talk about it like a storm to sea, but history shows us that storms pass, and every time karma sees it to follow. Whilst it's going to be really challenging when you hear the inauguration of a president that you may not have voted for, or that maybe you did vote for, and what tariffs could mean, what anti-migration laws could mean, what geopolitical unrest could mean. Being able to stay the course and ride out the volatility will see you through at the end. And I think we'll go to lesson 3. Because a lot of times we're getting a lot of market news before the markets really start underperforming. We're hearing about what's about to take place. And sometimes we've had financial advisors and investors tell us, we knew this property bubble was happening, or we knew that US market was under stress, or we knew there was geopolitical risk. Why didn't we do something about it? Why didn't we avoid that asset class? And I love these next 3 slides for a reason. They're all very similar, but in this first scenario, we're looking at the S&P 500. And this chart shows daily market returns for the S&P 500 going back to 1980. What it highlights is fascinating, because the best and the worst trading days are often right next to each other. So when you ask the questions, how could I have avoided this? A lot of the times your financial advisor and Vanguard will say, stay the course. The cost of trying to go in and out of the markets to avoid a bad day and to get back into a good trading days is where most of the benefits will take place. So from a Vanguard perspective and from your financial advisors, they don't want to take that risk, and the friction of being able to go in and out of markets effectively and in a cost-effective enough way reduces the motivation to actually pull out of those markets. Now, that was the S&P 500. So they were the stocks from market cap from the top 1 stock of the US all the way to 500. But now let's have a look. Is it different in other regions? Now we're looking at the MSCI All World Index, and that takes into account not only the US, but also takes into account global markets around the world. And what do you notice? 10 of the 20 best trading days occurred in years with negative total returns. 11 of the 20 worst trading days occurred within a year of the positive returns. Again, they're almost side by side, a good trading day versus a bad trading day. The friction of being able to go in and out different positions end up costing you money, not making you money. So the volatility you're trying to avoid in the first place is counteracted. So first we showed US, then we showed you what was happening globally, and now even in Australia, a market that makes up 3% of the global market, and yet similar themes. What do you see here? This goes from 2000 all the way to 2024. And what do you see? 10 of the 20 best trading days occurred in a calendar year that also had negative returns. 13 of the 20 worst trading days occurred with positive trading days. So timing the market is like trying to catch a train by standing right at the edge of the platform. You might step back in fear just as the train pulls in and then miss your ride opportunity altogether. If you miss just a few trains, your whole journey will be delayed. In investing, It's exactly the same. Missing that compounding flow will have the same detriment. That's why we say again, not timing the market, it's timing the market. And so what we've tried to do, and this puts us onto lesson 4, and this is about diversifying. If lesson 11 showed us that timing the market is futile, lesson 4 tries to talk about trying to pick winners. It can be just as difficult. And I love that slide you had from JP Morgan, Sarah, diversification across the different countries. And we look at the same way when it comes to all the major asset classes, the building blocks of portfolio. The next chart. The quilt colorful chart. It looks complicated, but the message is simple. Each color is an asset class. Australian shares, international shares, property, bonds, cash, and so on. Each column up the top represents the year. Even professionals, people that do this for a living, can't consistently pick which assets will be the winner each year. And if you chase last year's winner, the asset class, and try and maintain that, you'll usually end up holding next year's loser. So the takeaway here is the only reliable way to capture return is to own a diversified mix of all of them. Diversification ensures you don't need to predict winners. You don't need to have a crystal ball. You participate in the growth across markets while smoothing the ride all the way along. The reason why when we were speaking about AI, we wanted to talk about all the different industries is to really highlight that it's going to be all the different industries that incorporate AI that really benefits. We had the Magnificent Seven and the reason why we should be looking at tech stocks, but we think you should be looking beyond that and look at what are the sectors and maintaining an equal balance of those sectors. Think of it like picking the winner of a Melbourne Cup every year. Some years the favourite wins, some years it's a rank outsider. Even experts with form guides get it wrong. But imagine instead of betting on one horse or one AI agent, you owned a share of the whole field, all the horses, all the asset classes. You'll always collect the winning ticket. So the lesson here is pretty clear. Don't chase the winners. We encourage financial advisors to do that and to have that conviction about diversification. It's simple. It's the simplest and the most reliable way to build your long-term wealth. I can't see if any questions are coming out, but I will move on to lesson 5. So with lesson 5, I think we're going to talk about tuning out the noise. And I think this is probably one of the hardest lessons that we're all able to adhere to. I remember when I first started at Vanguard, and they've always had this really strong view about trying not to time markets. And it was just after the GFC, and I'm not sure if any of you remember, there was a whole new set of noise hitting the news channels, and it was about the fiscal cliff. And this fiscal cliff was going to possibly state that US governments across their country were going to have to close down, pensions wouldn't be paid, and with the collapse of the US, it would have global implications for everybody. And I had to give a presentation in Canberra on trying not to time markets. I found it very difficult given we'd just been through the GFC and now faced with a new story with fiscal cliff. I spoke to our global heads of research and asked them, are they sure this time isn't different? They went on to tell me, trust us, staying the course will be one of the best things you can do. When we look back and plot our returns over the long term, and look at all the risk profiles from a very conservative investor all the way to a high balanced investor. If you stayed the course from the GFC, you didn't make a move when you were worried about the fiscal cliff, your ability to reclaim losses, if you're a conservative investor, could have happened in the first 6 months. If you're a balanced investor, 9 months, and you would have regained any losses from the GFC within 9 to 12 months for all for all risk profiles. Now, I continue to meet people that have stated since the GFC they've been too wary to ever get back into markets. And what worries me is the opportunity costs that were lost. So tuning out the noise is probably one of the hardest lessons, but one of the most important ones. So we'll wrap up this lesson with having a look at some of the geopolitical sell-offs that are typically short-lived. And this chart is a great example. It shows market performance across major geopolitical events, because that's the stuff that makes the news. The sadness and the wars going on, invasions, political crisis, they can't go unmentioned. What do we see though? Markets often react sharply in the short term, but those sell-offs are typically short-lived. Within months, sometimes weeks, markets are already recovering. We've seen it numerous times just this year. Over the long term, the impacts of those events is often just a blip on the chart. So reacting to headlines, fears, and noise usually means selling low and missing the recovery. The real risk isn't the event itself. It's letting short-term emotions derail a long-term plan. Think about it like driving a car. If you jerk the wheel every time you hear a loud sound, you wouldn't end up getting to your destination. Investing is the same. So across the 5 lessons, the story is pretty simple. Harness compounding. Do me a favor and stay the course. Focus on timing the market and not timing the market. Diversify across all those asset classes and tune out the noise. Listen to trusted resources like Sarah and the apt group. And I think that is the end of the presentation. How are we for time?
Thanks very much, Julie. That's great. Thanks, Sarah. We don't have any time for questions today, but what we'll do is we'll get those questions answered when we send out the recording for everyone. So if you do have any questions, feel free to keep putting those in the question and answer box while we wrap up, and we'll get those answered for you. Yeah, there's no doubt this is not a fad AI, and I keep telling myself that the AI we're using today is going to be the worst AI that we will ever use in our lives again. So I really appreciate the amount of work that Vanguard has done there on the occupational and industry analysis of AI. I think it really brings to home that this is going to totally transform the way we all live, the way businesses operate, and we've got to think about that in terms of how we're investing. It's not just going to be the tech and AI stocks that benefit from this AI. It's going to be very widespread. So,
and Andrew, I'd love to know if there are feedback forms or when you're speaking to your people, how many people are actually using AI? And if you're not using AI, I encourage you all to give it a go. Download one of those apps. A lot of it is for free, and start using it. It's amazing where it will take you.
Yeah, thanks, Julie. And if you're not using it now, we will be soon, that's for sure.
For sure. Sarah?
So, look, thanks very much to Julie and Sarah for giving up their time today. Really interesting presentation theme for the day. I hope it's been useful for everyone. If you've got any other questions after today's event, you can always go back to your advisor and we'll get those answered for you. Keep an eye out for more events coming your way. We'll try to put forward as many interesting topics as we possibly can to help. But tune out that noise and focus on the long term. That's really the message from today. So we look forward to seeing you all soon. Thank you again.
Thank you, everyone. Have a great day.
Thank you.